Hello everyone, John A.G. here, and I'm about to say something that's going to make a few people uneasy. If the monetary system is fracturing the way it appears to be, then asking the question, when should I sell my gold and silver, might already mean you're asking the wrong thing. Because if that question is on your mind right now, it's like standing on the deck of a ship that's already taking on water and haggling over the price of a lifeboat. Before we go any further, let me ask one quick, honest favor. My YouTube analytics show that most people watching these videos aren't subscribed. So if you're getting value from this content, hit the subscribe button and drop John AG in the comments so I know you're with me. All right, let's get into it. Because overnight we saw gold push back toward the upper 4,800 range again, and silver flirt with the mid to high 90s, and I know exactly what that does to your mind. It activates that inner voice that says, this is the top. I should take profits. I should lock this in. I don't want to ride this thing all the way back down. And look, that voice isn't insane. It's trained. It's been trained by decades of fiat-based thinking, decades of charts denominated in currencies that steadily lose purchasing power, decades of sell-the-rip advice from people who behave as if the current system is permanent and untouchable. But here's the cliffhanger I want you to hold on to. What if the thing you're measuring your metals against is actually the thing that's failing? What if the real objective isn't to cash out into paper, but to carry real money into the next chapter and then exchange it for assets when the ratios finally make sense? That's exactly what we're going to unpack today, step by step. We're going to talk about what a top-tier macro investor recently said that essentially let the truth slip out in plain language. We're going to connect that statement to what bond markets are screaming right now, and then we're going to address the real question. If you don't sell into fiat during what looks like a monetary breakdown, then what actually is the exit, and how do you recognize when it's time? Yes, I'm going to give you a practical framework, simple, memorable, usable, something that keeps you from relying on vibes, emotions, or panic. One more quick thing before we get into the core of the video. Check the description below. I've included bonus links there, including access to our premium WhatsApp channel and an option to join channel membership if you want to go deeper and support the work we're doing here. Now, the mainstream financial world has a talent for disguising reality behind polished language. They don't say the system is wobbling. They call it a liquidity event. They don't say the debt can't be repaid. They call it a fiscal adjustment. They don't say people are losing faith in paper promises. They label it a risk-off rotation. But every so often, someone at the top slips and tells the truth without the usual filters. And that's exactly what happened this week. A billionaire hedge fund heavyweight, one of the most recognizable names on the planet, sat down at a major global gathering and effectively said, the monetary order is breaking down. Not slightly, not temporarily, the order itself, the framework, the belief system. When someone at that level says something like that, you should lean forward. That's not entertainment. That's a signal. I'm not asking you to idolize any individual. I don't care who said it. What matters is what it implies. And what it implies is that central banks are changing how they behave, capital is flowing in new directions, and long-held assumptions about so-called safe assets are being questioned by the very people who once promoted them. Here's the key point, and I want this to land clearly. Fiat currency is created as a liability. It is born from debt. Somewhere in the system, there is always a matching IOU. Gold doesn't carry that shadow. Silver doesn't either. There's no matching promise that can default, no counterparty that can collapse and take your purchasing power with it. That's why, when systems come under stress, people don't run toward more promises. They run toward what already exists. And it's not just retail investors doing this. It's institutions. It's central banks. It's large pools of capital with better data, better advisors, and better timing than you or I will ever have. So if that's the environment we're in, let me ask you something most people never stop to consider. Why would you sell your lifeboat while the ship is still listing? Now I know what some of you are thinking. Okay, John, but everything has a price. Surely there's a level where you sell. And this is where the answer surprises people who are still mentally anchored to dollars, pounds, and euros. My answer is this. I'm not planning to sell gold and silver for more paper. I'm planning to exchange gold and silver for real assets when the ratio becomes absurdly favorable. That's not wordplay. That's strategy. Selling for fiat assumes fiat is the destination. And if the monetary order is breaking down, fiat is not the destination. At best, it's a temporary bridge. More often, it's a trap. So imagine shifting how you measure wealth. Instead of asking how many currency units you have, you ask how much real stuff you can claim without asking a bank for permission. Land, businesses, productive equipment, inventory, rental properties, farms, energy infrastructure, skills, even something as simple and powerful as a stable, debt-free home. And the way you move from metals into those assets isn't by staring at a price ticker and trying to call the top. It's by watching ratios and behavior. Here's an analogy that tends to stick. We're on a monetary Titanic. Most people are still dancing in the ballroom because the music hasn't stopped. They're gambling in the casino because the lights are still on. They're watching the stock market because the scoreboard still updates. But you and I can feel the vibration under the floor. We can see water seeping through the seams. We notice the crew looking uneasy. Gold and silver are the lifeboats. Gold is the larger, more compact lifeboat. Fewer people can afford it, but it stores immense value in a small, portable form. Silver is the more crowded lifeboat. It's heavier, takes up more space, but it's accessible to more people and has a long history as everyday money when things get strange. If you knew the ship was going down, you wouldn't throw the lifeboat overboard just because someone offered you casino chips in exchange. So when do you sell? You sell when the lifeboat can buy you something better than safety. You exchange it when it gives you control, stability, and long-term productivity. That brings us to the practical framework I promised. I use 3 filters. Filter number 1, the system signal. If bond markets are cracking, currencies are being devalued, and central banks are stockpiling gold, the system signal is flashing red. That is not the moment to reduce your insurance. That's the moment to be extremely careful about what you call profits. The biggest mistake people make during monetary transitions is selling real money too early and buying paper claims right before those claims get repriced. Filter number 2, the ratio signal. Stop asking, is gold expensive? Start asking, what does gold buy? How many ounces of gold buy a house where you live? How many ounces of silver buy a reliable vehicle? How many ounces of gold buy a diversified income-producing asset? When those ratios hit historical extremes, when real assets become cheap in gold terms, that's when exchanges make sense. Most people will do the opposite. They'll buy houses when houses are expensive in gold terms because the dollar price feels familiar. You won't, not if you're paying attention. Filter number 3, the personal signal. This part rarely gets discussed because it isn't flashy. Your real life matters. If you need liquidity for an emergency, if you're protecting your family, or if you have a business opportunity that creates cash flow, then yes, you may exchange a portion. The goal isn't to die holding perfect coins while missing real opportunities. The goal is to survive and thrive. Now let's connect this to what's happening in markets right now, because this isn't theory. Bond markets are supposed to be boring. They're supposed to be the quiet, stable corner of finance. When bonds start behaving like meme stocks, that's a warning flare. We recently watched long-term government bonds in a major economy get crushed, then bounce. Some people called that stabilization. Traders call it something else, a bounce in a falling market, a pause before the next wave. The math is unforgiving. Massive debt loads combined with rising rates create servicing costs that become politically and economically impossible. Policymakers then do what they always do: cap rates, print money, or rewrite the rules. Every one of those outcomes is ultimately bullish for hard assets, even if the path is volatile. Add inflation to the mix. Real inflation, not the sanitized version. We just saw consumer price data in the UK move higher again, and regardless of which number you trust, the message is clear. Cash in the bank is losing purchasing power, and most deposit rates don't compensate after taxes and real-world costs. This is the silent tax, the one nobody votes for, the one that punishes savers and rewards debtors. Once you truly understand that, you stop viewing gold and silver as investments. You start seeing them as stored time, stored labor, stored purchasing power that you can redeem later when the world finally offers bargains. I also want to address trading, because some of you are thinking about futures, options, and timing tops. There's a place for speculation, but in a monetary reset environment, speculation is where people get shaken out. Paper markets can swing violently, prices can dip, headlines can scare you, commentators can ridicule you. That's the mechanism. It's designed to make you abandon the lifeboat because a chart turned red for a couple of weeks. If you're building real protection, separate your metals into 2 mental buckets. Bucket 1 is core protection. This is untouchable unless you're exchanging for a major life upgrade or a generational asset. Bucket 2 is tactical. This is where skilled individuals may rebalance or trade around moves, but you never jeopardize your core for a tactical win. This brings us back to the macro investor's comment. When someone at that level admits central banks are changing how they treat fiat and debt, ask yourself what they're holding instead. The data answer is gold. Not because it's fashionable, not because it's a meme, because it carries no counterparty risk and has settled value across empires, wars, and collapses. Respect the flow of capital. Now let's talk psychology, because this is where most people lose. Gold rises and they feel brilliant. Gold dips and they feel foolish. That emotional whiplash is a fiat mindset. A real money mindset measures wealth in ounces, not in paper quotes. The paper price is the opinion of a stressed system. The ounces in your hand are reality. So when you ask me, John, when are you selling? My answer doesn't change. I'm not selling my insurance policy just because it became expensive. I'm holding it until the world offers me an exchange that's too good to ignore. Imagine a future where a decent piece of land costs 1 ounce of gold. Imagine farmland priced in ounces instead of constantly shifting currency units. Imagine building materials and labor repriced so that those with real money can build while others beg for loans. In that world, selling isn't about hitting a price target, it's about converting stored purchasing power into long-term production. And it won't happen all at once. It will come in waves. That's why you exchange in tranches as ratios become attractive. Quick side note, because I get asked about this often. If you want to hear silver-related success stories, there's a link in the description to another channel that focuses on real people and real outcomes. Check it out if that's your thing. Back to the core. Another indicator I want you to watch is the Dow to gold ratio. Take the stock index and divide it by the price of gold. When that ratio falls, gold is outperforming stocks. Major regime shifts show up there. If that ratio compresses further, it signals a slow rotation out of financial assets and into hard money. Someday, if gold becomes extremely strong relative to equities, exchanging gold for productive businesses could be the trade of a generation. But not today. Not while the ship is still listing and policymakers are pretending everything is under control. Be careful not to fall into the opposite trap and assume this means never exchange. Gold isn't the end. It's the bridge. And the end goal is control over your time, your stability, and your family's future. Silver deserves its own moment here. Silver is emotional, it's volatile, it humbles traders, but that volatility is also why it can be powerful during transitions. When silver moves, it can shock the public, and suddenly the affordable lifeboat disappears. Ask yourself this: when silver gets attention again, will the average person be able to buy it easily at will, or will they encounter delays, premiums, and empty shelves? That's why you build positions before euphoria arrives. Now I want to hear from you. First question: when you think about your metals, do you think in price targets or in what they can buy? Second question: if the monetary order is shifting, what real asset would you want to exchange metals for first? Land, a business, a home, equipment, something else? Share your answers. And if you've had any financial win, big or small, share that too. Even paying off a debt or building a small buffer matters. Your story can help someone else more than you realize. The core theme here isn't that gold is going up, it's that the credibility of paper is going down. And when credibility erodes, capital demands compensation or exits entirely. That's a capital war. Not tanks, not bombs, flows. Trying to time a gold top while trust itself is being renegotiated is the wrong game. The better game is holding what doesn't require trust and waiting for real opportunities. So here's a simple do this, not that list. Do this. Maintain a core position of physical metal you can access, not that, don't leverage it. Do this. Track key ratios monthly. Not that. Don't obsess over daily price noise. Do this. Define what you want to acquire and at what ratios. Not that. Don't wait for the news to say it's safe. Check the description for bonus links, including the premium WhatsApp channel and membership options. For those who want deeper research, we also publish members-only content with a dedicated research team. So where does this leave us? In a world where gold and silver are protection first, not trades first. They are a vote against debasement, a way to step outside promises. And if you treat them that way, you're less likely to panic sell during manufactured scares. Monetary systems don't collapse in a straight line. They fracture in phases. Confidence erodes quietly. Markets send strange signals. Authorities respond with distortions. Then suddenly, the public realizes the rules changed. The question isn't if that moment comes, it's whether you're positioned before it becomes obvious. Am I selling my gold and silver? Not into paper. I'm holding, watching ratios, and preparing to exchange into real assets when the opportunities are historic. If you want more content on specific ratios and scenarios, tell me in the comments so I can tailor future videos. Subscribe if this helped. Drop John AG below. Take care of yourselves, take care of each other, and I'll see you in the next one.